Hey, fellow investors, bonjour. My name is Mike Giroux and I'm the founder of Dividend Stock, and I'm also a passionate investor. You have been hearing me talking about what I call the Dividend Triangle. This is my number one step for my investment process, where I look for each stock's the revenue growth, the earnings per share growth, and the dividend growth over the past 5 and 10 years. And then it tells me a lot about this company. In this video, we're going to have 6 examples on what it looks like, how to read it, and what's the difference between the trend and also the 5-year numbers. So we're going to look inside Dividend Stocks Rock, my membership platform, where I talk about the Dividend Triangle, and I'm going to help you read it. You're going to see, you're going to save a lot of times. You're going to be able to make up your investment thesis the right way and avoid dividend cutters. All right, let's go. All right, so now we are inside Dividend Stocks Rock. We are looking at stock cards, but the only place that we're going to look at today is the Dividend Triangle. So the Dividend Triangle has 3 components. The first one is the revenue growth. The second one is the earnings per share, and the third one is the dividend growth. You see also the 5 years annualized growth rate for revenue, earnings per share, and dividend in this case. As you can see, we are starting with a nearly perfect dividend triangle from Costco, ticker COST. And you see how a company that is thriving and growing their sales, growing their profit, and sharing the wealth with shareholders. And we can see how the stock price started around 2015 at like below $200, and it goes all the way up to nearly $700 in only 10 years. So what I wanted to show you here is how revenue and earnings are growing at a very similar pace. You see that in the trend, and then you see that in the numbers. So for the 5 years at 11.35 for the revenue, and then the earnings at 15%. What it tells us is the company is able, as it grows, to maintain its margin and to generate pretty much the same, and in this case, a little bit more profit every time they increase their sales. So already you can see a stable business model geared towards growth with some pricing power or negotiating power to maintain their margin, regardless of the type of economic environment. This is what I like to see over the past 10 years, but my focus will always be for the last 5, because the last 5 will really tell you what is going on right now and what are the chances that the next year is going to be good or not. So we see not really a sign of slowing down for revenue or earnings. And then for the dividend, it's a little bit more complicated to look at it here, mostly because the company pays a special dividend over here, there, and over there. If you look though at the regular dividend payment, it was like 40 cents back in 2017, and then all the way up to $1 and $2 in 23. So you see that there's definitely a growth, and the 5-year will help you understand which kind of growth it is. It is a little bit lower than the earnings per share, which is great, telling you again that the payout ratio will probably be stable throughout the years, and a little bit lower because as earnings are increasing at a rate of 15% per year, the dividend is increasing at 12, leaving plenty of room for growth and plenty of room for more dividend increases. Now we're going to move into my second example, which is Microsoft, another of my favorite stock. This one, I wanted to show you that sometimes you're going to see some drop in a specific graph. So the revenues are pretty much stagnant here, and then it goes up for the rest of the years. And then the earnings, you can see it was like a rougher time. So probably a more difficult time to analyze the company. But after that, we see that both of them are growing almost at the same. When there's a slowdown right here in 2023, 2022, you also see a slowdown in the earnings per share. But this one is a great example of how fast the dividend can grow and how stable. Now, if you're in a situation where the stock price actually goes down from 2022 of like peak nearly $350 all the way down to like 230, and then we got 239 and then 225, you see that the stock price has declined sharply in 2022. about 25-30% down in that year. So then you may be thinking, when you look at a stock like this, you're just like, oh my God, the stock price goes down all the way 25-30%. I should probably sell and cut down on my losses, or just like cover some of the profit and move on. But when that happened, I was looking also at the rest of the triangle, and I saw, well, revenues are going up, earnings are relatively stable, and then I got another increase here of like 6 cents from 62 cents to 68 cents a share. So the company's telling me the numbers are still going good. Yes, it's not the best year ever, but we're still growing, we're still thriving, and we still have confidence in our business model, so we increase our dividend. So at this point, I didn't care if the stock price dropped because the metrics were really strong. So no matter what the narrative around technology sector that was going down and interest rate was going higher up and it affected the valuation, I saw a thriving business and I decided to keep it for that reason. And then fortunately, that gave me a pretty good reason to smile now because it's all the way back up in prices. Another example that I want to show you here, which is not as clear as a great dividend triangle. You see here, there's like a bumpy ride everywhere. And this one is from National Bank, ticker NA.TO. So we see that the revenues are going up, so that's a good sign. But for the earnings per share, there's definitely a problem here where it's starting to go down actually in 2020. And then we have another one where it's going down as well in 2023. Even worse, during that period, that crucial period of 2020 to almost 2022, we have no dividend increase right here for like 5, 6, 7 quarters in a row. So when you look at the trend like this, instead of looking at the numbers, because if you look at the numbers, you're just like, yeah, high single digit, double digit, everything is perfect, right? Well, it's not the case because we see that in 2020, there's a problem. So when you see that there's a differentiation, a problem in the graph, that tells you, oh, I need to investigate. I need to dig a little bit deeper in this specific period of time to know what happened between 2020 and 2022. Well, this one is easy, and that's why I decided to pick it for the sake of this video. Is we all know it was COVID. We all know that banks were not allowed to increase their dividend by regulators. Regulators was just like, you know what? We're going to give a lot of money away. We're going to give out loans with no interest to people to make like business, to save businesses during that crazy period of time. So you banks, even if you're making money, we are not letting you increasing the dividend during that period. So that was a time in history where the stock price had a hard time, the revenue stagnated, the earnings per share declined, and there was no dividend. But then you have an explanation. So you are able, by looking at the graph and doing some due diligence, to have a clear explanation of what's going on. Once you understand what's going on, you're in a much better position to determine if National Bank should be in your portfolio or not, according to your investment strategy. Another key point I want to highlight here with the dividend triangle of Alimentation Couche-Tard, ticker ATD.TO, is how when you see the revenue that declines and then you pair that with the earnings per share fluctuation. In this specific case, because of the lockdown, there were less sales of gasoline. We saw that revenue dipped, obviously, because a big part of Alimentation Couche-Tard's business is all about selling gasoline, right? But when we look at the earnings, they were relatively flat. So while the revenues are going down, it shows you that the business is able to find other ways to improve their margins. So they quickly reacted. It's a proof of a very strong management team where they were able to face a storm and find a way to maintain their margin and actually improve them and maintain their earnings per share while revenues were going down. Again, this is a great example of a dividend grower. As you can see, revenues are going up by 8%, but earnings are increasing a lot faster, telling you that the company is able to innovate, improve their margin, cut down on their costs, and obviously share the wealth with shareholders. Now, I've showed you a lot of great examples. It's time to move on to not so great example and tell you about what's going to happen with a company that is struggling. This Dividend Triangle, you can see not looking as great, right? Revenues are going down, earnings are going down, and the dividend is barely increasing by about 1 cent every year. So yes, it is qualified as a dividend grower, but it's not doing that well. What's that stock? I'll let you a second to guess. You can see the stock price has not done much in the past 10 years. Well, there's an explanation for that, and the numbers are driving this explanation. Revenues are constantly down, earnings per share are following, and then we can see that the company is struggling with increasing their dividend. So that company is IBM, and if you have followed this business, well, they showed for about 5 years of consecutive quarters with a revenue decline. So while they are telling our investors, they were trying to build a narrative where, oh, we're moving towards the cloud, and those like new business segments are growing, their core business was slowing down so fast that it was impossible for the new segment to compensate. So we see a company that used to be a stellar business and now having a hard time quarter after quarter. So now today, it would be a good time to revisit IBM and to see what's going to happen next. As you can see, there's some hope with the stock price. The revenues are starting to go up a little bit, and then the earnings got a big of a dip here, but then it's going back up. Well, they have spun off their cloud business, and now they're completely two different businesses, and then it's probably a good timing to look at it again. But for those years between 2015 and 2020, I was not keen on IBM because I saw the revenue going down, I saw the earnings go slowing down, and I saw also the dividend growth slowing down. So before that, we had like some generous dividend increases, and then right here, we're starting to have like barely nothing. So that is also a sign that the company is not doing that well. Not incredibly alarming, but I'm not expecting much from IBM. And here, at one point, we're going to talk about a potential dividend cut here if the revenues and earnings cannot go back up. I mean, it's impossible for the company to sustain a dividend growth policy. Now, the last one, and definitely the least in this case, this is a dividend triangle showing you a very high potential of a dividend cut. So we see something kind of strange because the revenues are increasing steadily, but the earnings are incredibly hectic, and it's almost impossible to make up to know exactly what's going on. But the big red flag here is we have hectic earnings and we have no more dividend increases since 2020. This dividend triangle is from Energex, INE.TO, a utility company based in Canada focused on renewable energy. So we see that they're investing massively in new projects, which explain the revenue growth. But then we start having like hectic earnings per share and no dividend growth. We see that the numbers are not that great, and everything tells me that if the company is not able to put back their earnings on track, chances are we're going to have a dividend cut. So this is the type of dividend triangle that will raise the red flag. And now if you do further research, you will realize that this company has been showing a payout ratio above 100% for more than 2 consecutive years. So when you combine a stock that has no earnings growth trend, no dividend increases, and a high yield, well, those are all the red flags combined together to say I will not be surprised if Energex cut their dividend. And actually, the market here kind of like tell you this is exactly what's going to happen. So this is a way where if I see that this business is not showing strong numbers, even if it has a seductive narrative that everybody wants solar or wind energy, and the CEO is telling you, oh, we have like a bunch of backlogs and a bunch of contracts coming up and it's all pinky and unicorns. Well, when you look at the numbers, the narrative doesn't match the dividend triangle. So when that happens, it creates a distortion. And this distortion, once you have to do some due diligence, you put everything in their context, and now you're in a better place to make your decision. In this case, I cannot be convinced by numbers that this company is doing great. It doesn't make any sense. The revenues are going up, but there's no profit or barely no profit. And the management is not confident enough, and actually definitely prudent in this case. It's a pretty good idea to not increase the dividend. But if the company cannot increase its dividend, I mean, expect the worst because interest rates are still higher up. Even if we now expect some rate cuts, we're not going to go back to 2% anytime soon. Inflation is still around and the global economy might not thrive in 24. So what's going to happen with Energex when they face more speed bumps than anything else? Well, you guessed it, probably a very tough year that could lead to a dividend cut. All right, guys, I hope that you have enjoyed this video. I hope that you have understood a little bit better how to read a dividend triangle, how to make the difference between the narrative, the story behind a stock, and the numbers, and finally, making sure that both of them, the narrative and the numbers, are working together and they are stable. When you are able to find companies with a stable growth, then you're on the right path. To help you out, I've built the Dividend Rockstar list that you can download in the link description below. The Rockstar list is a list of all the companies at Dividend Stocks Rock that shows a positive dividend triangle. It's not a buy recommendation. You should do your due diligence, but it's a good starting point. If you are already a member at DSR, well, you can build your own list using the filter, and we send that list every quarter to our pro members as well. So, all right, guys, that's enough for today. And if you have any question, you can go on the YouTube channel, click on the link below to download the Rockstar list, or leave me comments about the dividend triangle. I'm always here to help. I'm always there to help you invest with more conviction so you can enjoy your retirement. All right, until the next video, don't forget to stay invested.